Good morning, welcome to Ainsley News. Today we're talking about the downside of globalisation. Globalisation has been a key economic trend for the last few decades. Never before has the world been so interconnected economically, and as COVID painfully revealed, nor have supply chains of essential services been so reliant on offshore suppliers and international freight lines. Such interdependence means a shock or break anywhere in the world can have ramifications across the globe. Just in the last couple of days, this has been laid bare through China's hostile reaction to the sanctions on its human rights abuses, and overnight, even the seemingly innocuous blockage of the Suez Canal, shocking and moving markets. Chinese officials have warned the EU do not play the role of human rights preacher anymore and do not go down the wrong path, expanding on the latter to Germany, saying in a meeting yesterday that Europe and Germany must correct their false path to avoid further damage to their bilateral relationship. They also warned China never provokes, but we will never back down from provocations. Rabobank's head of financial markets research in the Asia Pacific, Michael Every, knows this very and penned the following piece titled Correct Their False Path. It's worth reading as a warning that whilst there may be a fixation on what the 10-year US Treasury yield is doing, how much the Fed will print, or what the next inflation print may be, but in our interconnected and unbalanced world, our trademark, balance your wealth in an unbalanced world, is a mantra worth repeating. Yesterday's market movements were clearly risk off. Key bond yields were lower, equities were lower, oil was lower, and the USD was higher, except against the JPY. One can stoically say stochastic, but there was no obvious trigger for this shift in sentiment. It wasn't as if higher bond yields pushed stocks down. It wasn't as if higher energy prices pushed everything else down either. Some of the financial commentary this morning is trying to explain that assets were out of line with reality. Never! I already pointed out a key indicator of inflated asset valuations this week. It also says that stimulus can't just go on forever. Really? That's not the meme that we've been sold for months, or the one that central banks are still adamantly sticking to. In short, the simple message is that markets had to correct their false path. Logically, one could argue that there are risk-off drivers out there. However, here's some points here. Germany is going into further lockdown, at least until the 18th of April, warning of a whole new pandemic, and meaning a third of 2021 is a write-off. This underlines the degree to which the virus is still out there despite markets pricing for full global health for months. Hong Kong has made it clear it won't be removing lockdown until 50% of the people or populations are vaccinated. It's now sitting around 5%. And the UK, way ahead on vaccinations, says foreign summer holidays probably aren't going to happen. New Zealand's targeting of housing investment via taxes is a harbinger that populism is not going to be popular with all markets, and housing may be an easy target. US Treasury Secretary Yellen was yesterday also stressing the need for tax hikes. Massive market volatility in Turkey, despite its endogenous origins, could still spill over into the broader EM complex if it escalates. It again underlines politics can reign on the market parade. And the Suez Canal is blocked by a giant Chinese vessel, and there doesn't seem to be a plumber. Naturally, markets or algorithms will soon remember that vaccines in pill form are being floated. Hong Kong is just Hong Kong, and NZ is only NZ. Cornwall and Devon are lovely, taxes are for the little people, Turkey is Turkey, and there is always a cheap plumber in a globalised economy. Yet where market correction and reality overlap is that correct their false path is also the message China just delivered to the German ambassador. Allow me to unpack the implications of this just a little bit. China's aggressive counter-sanctions imposed on the EU over the latter's largely symbolic sanctions, China were not imposed on the UK, US, or Canada. This was either oversight or deliberate. If oversight, expect further Chinese actions and a souring of global relations, and a drift to a deterioration in trade and capital flows markets despise. If deliberate, China is picking out the EU as a weak link and focusing on Germany and its belief its corporates are the best leverage to prompt Europe to see the error of its ways, i.e. standing at the back and saying, yeah, while the US and Australia shout, and Australia and Canada take the punches. In which case, China does not understand that even in the EU, politics can trump economics. Spines are now stiffened, and the European Parliament has made it clear it will not pass the China investment deal while its own members and their families are under sanction. Yet, Beijing is extremely unlikely to blink, and so we again risk souring global relations, snowballing into a deterioration in trade and capital flows. History, like markets, until the last few weeks, seems to be happening on fast forward. And I reiterate, this matters far more than markets can grasp. Commentary correctly points out the S&P just had its best 12 months since 1936, where it rose 27.9%. They also point out what happened in 1937, where it collapsed 38.6%. Is this episode going to be repeated? It seems extremely unlikely central banks are going to repeat that particular error, premature policy tightening, to precipitate a similar crash. So all this is, well, no one really knows, eh? While central banks can stop at a 1937 or a 1929, they are powerless to stop a 1789 or a 1939 or a Cold War. And a 1937 being a year closer to 1939 is arguably more worrying an analogy as geopolitical tensions escalate. We just saw another US defense official warning about the risk of hot war over Taiwan, for example. Moreover, tech giant Intel is about to boost US semiconductor production via a USD $20 billion pair of new Arizona plants. Yes, we have a major supply squeeze in the industry all of a sudden, but plants take time to come online. And what does the firm now see? That the economics or market forces of where plants are located don't seem to make clear until recently. Back in July 2020, Intel was considering outsourcing production to other firms and countries, such as Taiwan. I'm not saying that the market is suddenly pricing for the geopolitical backdrop. It clearly isn't, even if it will react to individual events and individual firms reacting to it. Indeed, the retort I often get is that markets in general don't even know how to price in this kind of thing, so they don't even try. To which, in the Talibanese sense, ask yourself, how often would you and yours eat in a family restaurant with a reputation for being bombed, even if the steak frites are to die for? Of course, as we've already seen, not eating out means lower interest rates anyway, so perhaps there really isn't a problem. In short, one can worry about central banks tightening, and that would certainly see markets correct their false path. One can worry about central banks not tightening, and that would see markets on an even falser path. Yet one should worry most about the geopolitics of correct their false path, and that central banks are not about to do a thing about the path of history wherever it is leading us. Wow, lots of words today. Sorry we haven't got any charts, but there's some very, very interesting stuff there about globalization. So hopefully you found it informative. Remember ainsleyBullion.com.au for all things physical, gold, silver, platinum. AinsleyWealth.com.au for all things crypto. And GoldSilverStandard.com for our own cryptocurrency built and backed by real gold and real silver. Big news there with Gold Silver Standard this week as well. Jump onto our website and you'll see that you can now purchase through a decentralized exchange, or DEX. Jump over there and read more about that. We'll catch you tomorrow for more news.